Hi folks, when I first placed my first few trades over a decade ago, I had no idea about the mechanics behind them. The idea of being able to access various markets with the ability to purchase or sell felt amazing. I saw myself dabbling into Forex, commodities, indices, and even stocks with great ease. It was only after further research I realized that I was CFD trading, which felt alien. What is a CFD? It's simply a short for contract for difference. This is a flexible and popular type of trading instrument that allows traders to access the financial markets. In this video, I will cover the 4 W's of CFD trading: what, why, when, and who. Watch until the end to understand what the benefits and risks of CFDs are that ultimately make this instrument a trader's favorite. So what exactly are CFDs? CFDs are a form of derivative trading. This means that their value depends on the movement of an underlying asset. Traders across the globe can use CFDs to trade price movements of many different markets, including bonds, indices, shares, Forex, and even cryptocurrencies. With this form of trading, you don't own the underlying asset, you're only getting exposure to its price movement. Trading CFDs can be straightforward. If you think that the value of an asset will go up, you buy a certain number of CFD units or go long. If you think that the value of an asset will go down, you sell a certain number of CFD units or go short. A trader will make profit if the market moves in a predicted direction. This also means that a trader will make a loss if the market moves opposite to the direction they originally predicted. The key thing to remember, the profit or loss depends on the difference between the price you enter and the price that you exit. An example could be a trader who wants to go long on the euro dollar at 1.1300. The currency pair goes up to 1.1400, resulting in a profit for the trader if they close the current trade at the current price at 1.1400. Why trade CFDs? There are plenty of reasons why people trade CFDs. First one is the fact that it provides global market access. Trading CFDs allow traders to have access to a huge variety of markets across the world with all the traders under one central account. Number 2, leverage. CFDs are leverage products, meaning that profits can be magnified. This also applies to losses. Number 3, ability to go short. Certain markets have rules that prohibit shorting or require the trader to borrow instruments before selling short. CFDs can be shorted at any time without borrowing costs because the trader does not own the underlying asset. Number 4, flexibility. Because you can go long or short with CFDs, you can trade no matter which way the markets are moving. Number 5, you can exit at any time. Unlike regular stock markets where you can't exit until normal business hours, CFDs allow you to exit your trades in the middle of the night. And number 6, low minimum deposit requirements. A relatively small amount of money is required to start trading CFDs. One thing to keep in mind is that there are a couple of costs that come with CFD trading. These range from commission depending on where you are in the world, holding costs also known as rollover, and a spread, which is the difference between the buy and sell price of the CFD. When to use CFDs? Well, we already know that investors can use CFDs to predict whether or not the price of the underlying asset of the security will rise or fall. This form of derivative trading can be used any time from Sunday evening to Friday evening. CFDs are especially useful as a hedging tool because a short position can be replicated to hedge the exact position size required. For example, the trader may have a long position on an asset that is declining in value. By shorting that same asset, a trader can then earn money from that price decline and compensate for some of the losses from going long. The asset may prove resurgent and end up with an overall rise in value once the contract ends, with the hedge position diminishing a trader's profits in this situation. While a hedge reduces the profit that can be made from a trade, it reduces the amount of capital that can be lost. Who can trade CFDs? Anyone trading the financial markets. One can be a newbie, intermediate, or seasoned trader. CFD trading is popular on industry-leading platforms like MT4 and MT5, which are equipped with some useful CFD trading tools. FXTM offers both platforms for CFD trading on a variety of markets. Please be sure to like this video and subscribe to our YouTube channel for all things markets. Until next time, thank you.